Enron was once America's most admired company, a symbol of innovation and success. It revolutionized the energy sector, transforming itself into a trading powerhouse. Investors trusted its soaring stock prices, and employees believed in its future. But behind the scenes, fraud and corruption were destroying the company from within. Executives used accounting tricks to hide debt and inflate profits. Regulators and investors were misled by falsified financial statements. When the truth finally came out, Enron collapsed in one of the biggest scandals in corporate history. Thousands of employees lost their jobs and savings overnight. The company's bankruptcy shocked Wall Street and led to major changes in corporate governance. What really happened inside Enron, and what lessons can businesses learn? Like and subscribe as we uncover the rise and fall of this corporate giant. 1. Enron started as a natural gas company in the 1980s. Under the leadership of Kenneth Lay, it grew into an energy trading empire. The company pioneered the idea of trading energy like stocks, making billions in the process. Enron expanded into broadband, water, and even weather derivatives. It promoted itself as a cutting-edge technology firm rather than a traditional energy company. Investors were drawn to its rapid growth and seemingly endless profits. The company's stock soared, making it a favorite on Wall Street. But beneath the surface, Enron's success was built on deception. Its executives created a culture of secrecy, where financial manipulation was encouraged. Instead of real profits, Enron relied on accounting tricks to maintain its image. 2. The core of Enron's fraud was mark-to-market accounting. This allowed the company to record projected profits on long-term deals immediately. Even if a contract wasn't profitable, Enron could claim massive earnings on paper. This made its financial statements look impressive, attracting more investors. Executives used off-the-books partnerships to hide debt and inflate profits. These entities, known as special purpose vehicles, kept losses away from Enron's balance sheet. The company also pressured employees to invest their retirement savings in Enron stock. This created an illusion of unstoppable growth while masking financial instability. As long as the stock price stayed high, the scheme worked. But when confidence started to crack, everything unraveled quickly. 3. Jeffrey Skilling played a major role in Enron's rise and collapse. He joined the company in the 1990s and pushed for aggressive expansion. Skilling encouraged risk-taking and rewarded employees who delivered high stock prices. He dismissed concerns about financial transparency, believing Wall Street would always support Enron. His leadership style created a toxic culture where ethics took a backseat to profits. Employees who questioned Enron's practices were silenced or forced out. Skilling's strategies worked for years, making him a billionaire. But when reality caught up with the company, his reputation crumbled. He resigned just months before Enron's collapse, leaving others to face the fallout. 4. One of the biggest warning signs was Enron's relationship with its accounting firm, Arthur Andersen. The firm was responsible for auditing Enron's financial statements. Instead of ensuring accuracy, Andersen helped cover up the fraud. It shredded documents and ignored red flags to keep its lucrative contract. The firm's deep ties with Enron compromised its ability to provide independent oversight. When the scandal broke, Arthur Andersen faced massive legal trouble. It was eventually found guilty of obstruction of justice, leading to its downfall. The Enron case highlighted the dangers of weak corporate oversight and unethical accounting practices. The collapse of Arthur Andersen sent shockwaves through the auditing industry. 5. The turning point came in 2001 when analysts and journalists started questioning Enron's financial health. A Wall Street Journal investigation exposed inconsistencies in the company's accounting. Investor confidence began to waver as more details emerged. Enron stock, once worth over $90 per share, started to plummet. The SEC launched an investigation, uncovering massive fraud. Credit agencies downgraded Enron's rating, making it impossible to secure funding. As panic spread, employees and shareholders rushed to sell their investments. Within weeks, the company was on the brink of collapse. On December 2, 2001, Enron filed for bankruptcy, becoming the largest corporate failure in U.S. history at the time. 6. The fallout from Enron's collapse was devastating. Over 20,000 employees lost their jobs, and their retirement savings were wiped out. Investors who had trusted Enron's leadership lost billions of dollars. Former executives faced criminal charges for their roles in the scandal. Kenneth Lay, Enron's founder, was convicted of fraud but passed away before sentencing. Jeffrey Skilling received a 24-year prison sentence, later reduced on appeal. Other executives also faced legal consequences, but many walked away with millions. The scandal destroyed lives and eroded trust in corporate America. The financial damage extended beyond Enron, shaking confidence in the stock market. 7. Enron's collapse led to major changes in corporate regulations. The Sarbanes-Oxley Act was passed in 2002 to prevent future fraud. This law increased transparency and accountability in corporate financial reporting. It required executives to personally certify financial statements and imposed harsher penalties for fraud. The scandal also changed the auditing industry, making firms more cautious. Investors became more skeptical of companies with complex financial structures. Corporate governance standards were strengthened to protect shareholders. The lessons from Enron reshaped the way businesses operate today. Despite these reforms, corporate fraud still exists, proving the need for ongoing vigilance. 8. The Enron case serves as a warning about the dangers of greed and deception. The company prioritized stock prices over sustainable business practices. Executives manipulated numbers to create an illusion of success. Employees were pressured to ignore ethical concerns and follow orders. The culture of dishonesty led to one of the biggest financial disasters in history. The scandal also revealed how unchecked corporate power can harm thousands of people. It showed the importance of ethical leadership and financial transparency. Companies that prioritize short-term gains over integrity risk long-term destruction. The fall of Enron remains one of the most significant cautionary tales in business history. 9. Despite its downfall, Enron's influence is still felt today. Many businesses adopted more transparent accounting practices to avoid similar scandals. Investors now demand clearer financial disclosures and independent audits. The story of Enron is taught in business schools as a case study in corporate ethics. However, financial fraud continues to occur in different forms. Companies like Theranos and FTX have faced similar accusations of deception. The lessons from Enron remain relevant as businesses navigate financial pressures. Transparency, accountability, and ethical leadership are more important than ever. The legacy of Enron is a reminder that unchecked ambition can lead to disaster. 10. What can businesses learn from Enron's collapse? First, honesty and transparency should always come before profits. Manipulating financial statements may create short-term gains, but leads to long-term failure. Strong corporate governance is essential to prevent fraud and corruption. Executives must be held accountable for their actions and decisions. Employees should feel empowered to speak up about unethical behavior without fear of retaliation. Investors must perform due diligence before trusting corporate leaders. The Enron scandal proves that no company is too big to fail. Businesses that ignore ethical practices risk facing the same fate. Enron's downfall was one of the biggest corporate scandals of all time. It exposed the dangers of unchecked greed, financial manipulation, and weak oversight. Thousands of people lost their jobs, and investors suffered massive losses. The scandal led to new laws and stricter corporate regulations. Despite these changes, corporate fraud still exists, making Enron's lessons crucial today. Ethical leadership and financial transparency remain the foundations of sustainable success. Like and subscribe for more deep dives into the biggest financial scandals in history.